The Federal Reserve lowered interest rates a quarter point one more time just this past week. You're probably wondering, what does it mean for your hard-earned savings? Well, stay tuned. This week's episode of the Retirement Income Source, where it's all about your income.
And thank you for joining us today on the Retirement Income Source, where it's all about your income. I am Sarah Samuels here with David Scranton. And I just have to say, Dave, I know that you truly love our listeners. And you know why?
Why?
Because you're here with me in the studio recording our radio show right in the middle of the Fort Lauderdale Boat Show, which I know is one of your favorite events every year.
It's like my version of Christmas.
Yes,
right?
your version of Christmas.
Except what you don't know is I already spent 2 full days at the boat show. So
okay.
I got my fill. I
You've had
walked
enough
around,
boats.
got my fill, saw what was going on. Absolutely, yes.
Yes. Well, I'm glad you're here. And of course, I'm glad all of our...
And thanks for bringing my addiction to the attention of our listeners. That's awesome.
Yeah, well, I want them to know a little bit about you, get to know you. We already know that you're a pilot, of course, and you fly planes, but Dave also loves boats for everyone out there. Mm-hmm. But really today, the most important part of today's show is helping you can understand how you can protect and save your retirement savings in this time period. Especially, it's a little scary what's going on right now. I think a lot of people are concerned with the ongoing government shutdown. Now we have the Federal Reserve lowering interest rates, even though they're lacking some of that important data that they rely on to make decisions from September and from the last jobs report we have is August. I know.
And it's also, but I think what the Federal Reserve is leaning on is that a big part of the economic growth, what's known as GDP growth, right? Gross domestic product, has to do with government spending. So if the government is shut down, that alone is going to cause the economy to pull back. So without numbers, just knowing that, I think gives Jerome Powell that confidence to say, hey, we need to lower rates another quarter point. So just refresher for you who aren't really in tune with interest rates and how everything works. Simple. The Federal Reserve controls short-term interest rates. And they lowered interest rates for the first time in a while in September and again in October. And the question is now, will they do it one more time before the end of the year? They manipulate these short-term rates. It's called federal funds rates. Well, what is a federal funds rate? It's essentially the rate that banks lend money to each other for. So in other words, if a bank wants to make a lot of loans and they need to borrow money from the Federal Reserve, they borrow at this short-term rate. So the whole idea is that if they could borrow money cheaper, they can make loans cheaper, and hopefully it stimulates the economy. That's all short-term rates. Long-term rates are driven by the market. So when you see mortgage rates going up or going down, that's market-driven, right? When you see the 10-year government bond, the interest rate on the 10-year government bond going up or down, that's driven by market forces. Now, yes, it kind of sort of tracks what the federal funds does, because if the short-term rates go down, at least the long-term rates should go down. So where are we now with long-term rates? Well, we had the 10-year government bond as high as 4.7% within the last year. It just now clicked a hair below 4%. All right, so the long-term rates are starting to come down. And you can see that in the mortgage rates, frankly. Mortgage rates have come down a bit too. They were at 7% holding steady for a 30-year mortgage. And last time I looked, it was 6.15%. So again, the whole idea is by lowering rates, you'll stimulate the economy. Companies will borrow more money to buy capital equipment, to hire more employees. People were more apt to borrow money to buy homes, to buy real estate, maybe to buy automobiles. And that's the whole goal. Keep that economy stimulated.
Yep. And of course, the most important question that we're asking today is really how this affects people's retirement. And we've actually put together a one page of information all about the government shutdown, what is going to be affected, and what it could potentially mean for your retirement. So if you're looking for more information, an easy to digest bit of information that's all about how it's going to impact you, you can download that flyer by going to our website, which is incomeradio.com. But Dave, really, how does this impact people's retirement savings? What do they need to know?
All right, so most important factor, right? What it means is that the yields, and if this continues a few more times, as we suspect it will with the interest rates being reduced, it means banks are going to be less and less competitive. It was great. A year and a half ago, we had a period of time where you could buy a 1.5 year CD at 5% or more. Those days are gone. and those rates are going to continue to go down. So that's why you can't get long-term CDs at good terms. The short-term CDs have better interest rates, and even those are going down. So number one, your emergency money, short-term money, is not going to be earning as much. But number two, it also means that there's a downward trend in the long-term interest rates when you buy bonds or you buy preferreds or things like that. Not necessarily dividend stocks, but certainly bonds. So that means that if you're retired or within 10 years of retirement and you haven't started making that shift yet from a capital appreciation first, income second mindset, right? Where you're going just for capital appreciation regardless of whether or not it pays any income, any interest or dividends, to now an income first, capital appreciation second approach. It means if you're behind the eight ball on that, you probably should get started now. Because what do we know? We know the markets are high right now. And I don't know how much higher things will go because technology stocks have just gotten so overvalued by most measures. But we do know that generally speaking, when interest rates go down, it's a tailwind for those growthier names like technology, right? So that means hopefully that'll keep them aloft. Will they go up further? Maybe, probably, but at least they shouldn't, they might not drop anytime soon. We also know that when you transition those capital appreciation assets to a dividend play or an interest play, doing it now will probably give you more interest than if you do it 6 or 12 months from now because rates are going down in the future. So it makes now the time to say, hey, let's make that transition. Let's start the transition because, right, Sarah, as you know, you want to make that transition when your investments are high. So if you're changing over to interest-bearing instruments, you want to do it when they're high so you could put more money in those interest-bearing instruments. But it also means that you want to be earning a lot of interest. Right. You want interest rates to be high, so that bigger sum of money will generate more income.
Exactly. Yep. And I think that we've talked about this in previous shows, but now really might be the last opportunity that people have to lock in the higher than average interest rates. I mean, at just under a hair, 4%, there was a better time earlier, but if the Fed continues to lower the interest rates, now may really be the last chance.
Yeah, and the problem is people have FOMO, right? Just like they say, oh, well, I don't want to miss. The markets are going up. I don't want to get out now. Well, by definition, to sell at a high mark, you have to sell when things have just been going up.
Things are good, right?
So you can't also fall into the trap with interest rates and say, well, if I had done it 6 months ago, I could have got another 0.5%. You can't fall in that trap because you have to look at that's behind us. You have to look at moving forward. And it's important to understand that this isn't a light switch. It's not like, I'm capital appreciation first, all my accumulation years. I don't worry about any interest or dividends, any income getting paid. And then boom, I snap my fingers and go to an income first strategy. It's more like a rheostat. You're gradually changing it over. You're gradually brightening the room. And so it's just starting to make that change. And that way if interest rates go down further, hey, you've made a change at a higher rate with some. If they go back up again, well, you've left some money and you could make a change with more later on. So again, a rheostat, not a light switch.
Yep. Part of it is that sense of FOMO or that sense of, like you mentioned, nobody wants to get out when they're doing well, right? It's no fun to leave the party early when you're having a good time. But sometimes that's the best choice to be able to get enough of that income when you make that switch over. That's
right. And for another thing, too, for people who are far enough away from retirement and they want to start making the switch, dividend stocks for the last 2 years have been lackluster because all the tech names have just taken over, right? But when interest rates go down, dividend stocks typically look more attractive, right? Because they're like a bond. Interest rates go down and the price of the bond goes up. Well, so do the dividend stocks. So if you want to make that reduction now, start making that shift, guess what? You can do it and do it in a way where maybe just go into dividend stocks, maybe not even worrying about speculating on locking in long-term bond interest rates now. So again, but don't bury your head in the sand, take some action. And coming up, we're going to be talking even more about actions that you might want to take in today's economic environment of what we say is really a lot of uncertainty. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about your income.
You're listening to the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we are talking about what's been going on with really a lot of this economic uncertainty. And so far, we've seen the government continues to be shut down. Now the Federal Reserve has lowered interest rates by 0.25 percentage point, even though we're lacking a lot of that data that we usually get from August. That was the last time we had the jobs report. And now they're saying there might never be a jobs report that comes out in October. So, Dave, besides besides those factors, let's talk about some of the other things going on, right? The other economic uncertainty that has people worried.
Well, first of all, we don't really know how long the shutdown's going to continue. And if a budget does get passed, then versus just an extension so we could pay people, then the question becomes, well, what does that budget look like, right? So that's a huge question mark right now. Yep. Tariffs keep rearing their ugly head. It keeps coming up and so on. So I think we're going to be dealing with that for a while longer. And, 6 months isn't really enough time to know the effects that tariffs can have on inflation. I do believe they're transitory. Most people believe they're transitory. But then again, we heard those words come out of Jerome Powell's mouth at the beginning of the pandemic until he found out they were transitory, right? So there's some risk there for sure. And all of the geopolitical stuff too. I mean, there's a lot
of tensions.
There's a lot going on there. Now, the whole situation down in Venezuela and everything else. So again, lots of things that we have to worry about. And to me, that just tells Sarah, our average listener, that, when it comes to your money, you just need to play it a bit more conservatively. We've had a great run in the stock market. I mean, our run in the stock market is really, if you look at when you try to interpret stock market cycles, waves, there's like the microwaves, the macro waves, short-term, long-term, and all that. Look at a long-term wave. The market's been going up for the most part since it bottomed out at the end of 2008. So we've had 17 years of a strong market. Now, yeah, we had a little pullback, in the late teens, 1 year, small pullback during the pandemic, and then things ended the year up and roared on. So the markets have been strong overall, and they don't go up forever, right? When you go back in history, Sarah, as you know, that, even going back to the 1900s, 20th century, we had 3 periods of time, right, where the market was flat. And, everybody talks about the lost decade, 2000 through 2010. Mm-hmm. Yep. Well, really, it was the lost 13 years. It was January of 2000 through December of 2012, right? And guess what? All 3 of those elongated periods in the 20th century and the 1900s were longer. In fact, the shortest was only 16 years of the market being underwater. So, my message to you is that, look, if you are recently retired and you haven't made that shift to an income first, capital appreciation second approach, but you need income from your investments, then I encourage you not to push your luck. Now is the time to do it. Or if you're within 10 years of retirement and you think you've saved enough money where you're going to be okay, then again, now is the time to start doing it. Because, bottom line is that you retire for a reason. You don't want to go back to work. Mm-hmm. And, you push your luck too long and you just never know what's going to happen. And I hate to see that because there were a lot of people in the early 2000s who pushed their luck too long. I talked to a bunch of them, Sarah. Yeah. Who said,
I remember the stories. And even from reading your book, Dave, The Retirement Income Source, The Ultimate Guide to Eternal Income, where you talk about what happened back in 2000 when you saw what was really going on before that tech bubble burst.
I can't tell you the number of people who would say, look, Dave, I'm fine. I have all my money in the stock market. I'm taking income, but I have 2 years worth of my income sitting in a money market. So if the market drops, I can just withdraw 2 years from the money market and not worry about it. The stock market will come back. Well, guess what? It came back in 13 years. And some of those people, I don't know how it ever panned out because they never took my advice. So whether they ended up going back to work, whether they end up spending a lot less and scrimping on retirement, or whether a greeter at the local Walmart, I just don't know.
Yeah, and then if you're wanting to understand a little bit more in depth about what happened and why it happened and how you can prevent the same thing from happening, not having to go back to work, give us a call on our Ask Dave hotline. That phone number is 833-RIS-RADIO. Again, that's 833-747-7234. And if you qualify, after a few questions, we'll make sure that you get a copy of Dave's book for free so you can understand this a little bit more in depth. You're listening to The Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about what's going on in the economy. There's a lot of uncertainty, a government shutdown that's ongoing, Federal Reserve lowering interest rates by a quarter point, not to mention inflation concerns, the tariffs, and a lot of geopolitical things going on. So Dave, let's get into inflation a little bit more, because I think it's important for people to understand that even in times of prosperity, right, when everything is going well, inflation, particularly healthcare inflation, is always going to be a concern.
Well, it is. It's always going to be a concern. Prices go up, not down for any extended period of time. And even when inflation's low, you're still feeling the effects of inflation in previous years, because inflation is the change, year-over-year change in price. So if you had big inflation years previously, then, well, your costs aren't going down. They're just increasing at a slower rate. So certainly has to be part of the equation. And, I think this Federal Reserve target of 2%, I think is not necessarily a realistic number. I don't think there's a lot of thought into it. I think they kind of pulled it out of the air or maybe out of one of their body parts. I'm not sure. That's right. And it seems to be hovering in the mid-2s, and that's okay. But if it bounces over 3 again, well then, that's when the Federal Reserve has to get concerned and start taking evasive actions. But, there's 2 ways to have an inflation hedge, right? One is to get into things like dividend stocks, where with healthy companies, they increase the dividend over time. So it gives you an inflation hedge. Also, hopefully the value of the stock goes up over time, and that gives you an inflation hedge. But the other one is just not to spend all of your income, to reinvest some of your income. If you can get 6% income net to you, and you only need to spend 4, well, guess what? That's 2% that can be reinvested as an inflation hedge. And just to be clear for our listeners, Sarah, some people get confused with the word income. And because the word income means different things, right? The IRS defines the income as something that's a taxable amount. Well, that could be withdrawing principal, but it's taxable. The IRS calls it income, okay? That's not the best definition of income. Oftentimes your advisor will say, well, you've got $1 million. I'm sending you $40,000 a year of income. But how are they getting the income? In many cases, they're using those withdrawal strategies we talk about all the time on the show, where they're simply withdrawing the money from principal and hoping that it grows back, right? Well, you don't need me to tell you hope's not a retirement strategy. So that's not really the definition of income. That's a definition of cash flow, okay? The real definition of income is dividends and interest. It's true income. So it's like rental property, right? Rental property, you can make money in 2 ways. One is the rental check, and the other one is when the property goes up in value. Well, the neat thing about the rental check is that when you get that check, you can take it, you can spend it. So number one, you can predict how much it's going to be. You know it's coming, and you can take it and spend it. You can take it and save it. You can take it and pay off debt. You can do whatever you want with it. It's yours. It can never be taken back. But when that rental property goes up in value because the markets go up, guess what? That gain could be taken back. It can go back down again. So the power of income is it's a known return. It's a known return. You know what you're going to get. The capital appreciation component, you don't know, right? Sarah, put on your crystal ball, put on your hat. Okay, tell me, is Amazon stock going to go up or down in the next 12 months?
Up. It's going up. It's all up, Dave, to the moon.
There you go. You heard it. Up to the moon, right? We don't know the capital appreciation, but you know that income component. It's a known return. So even creating an inflation hedge from that, Sarah, is good because it's a known return. It's a known inflation hedge instead of an unknown one.
And the best part is you own the asset. So if you want to sell it later on, maybe when that capital appreciation has gone up, when you've maybe you don't need it for income purposes anymore, you can still make money in that way, right? By, let's say, selling the condo.
You haven't sold a thing to get the I component, the income. You haven't taken a dime of principal.
Yep, absolutely. Well, we are going to be taking your questions. So if you have questions about other inflation hedges that you can build, if you have questions about what's going on right now and how you can help protect your retirement, please reach out to us either on our phone line. That's 833-RIS-RADIO. That's 833-747-7234. Or you can reach out to us on our website, incomeradio.com. We're answering your questions next. I'm Sarah Samuels here with David Scranton, and you're listening to the Retirement Income Source, where it's all about your income. Thank you for spending some time here with us today on the Retirement Income Source, where it's all about your income. I'm Sarah Samuels here with David Scranton, and we've been talking about ways that you can help protect your retirement savings, especially with a lot of economic uncertainty with the government shutdown, with the Federal Reserve lowering interest rates. So it's a little chaotic out there, and unfortunately, there's chaos, but that does mean that we get a lot of great questions from all of our listeners out there. So we love answering your questions.
Very true. Yeah. Times of chaos bring good questions. and informed questions. And it looks like we were just talking about it at the break there. It looks like we've got some good ones.
We do. Well, let's get
hear
into
'em.
it. So we have Donovan in Cheshire. He said, Dave, you mentioned getting 6% income as an example. You just said that long-term government bonds are now under 4%, though. So how do you get that 6% number, and how do fees affect the income?
All right. Do you say Donovan? I'm sorry. Donovan. Okay. All right, Donovan. So two great questions wrapped into one. First of all, how do fees affect it? Well, what I'm quoting is a after fee number. So yes, you can get 6% after fees. And a typical management fee, as you know, might be 1%. Some a little less, some a little bit more. Let's say 1%. That means 7 gross, 6 net. So your question is, okay, how do we get that 7 gross, right? Well, remember, U.S. Treasuries have no risk. Like zero default risk, right? They have inflation risk and things, but zero default risk, unless you think that, we have a chance of defaulting on our debt, which is, I guess, possible considering we can't even balance the budget, right?
Anything's possible at this point, right?
So, but assuming no default risk, keep in mind that most people are coming out of stocks, and a lot of people are coming from growth stocks and riskier stuff, technology, right? So you don't need to go all the way from the frying pan into the freezer, right? From a lot of risk to zero risk. There are a bunch of things in the middle that generate income that have some risk but are considered a heck of a lot more conservative than the overall stock market, especially growth stocks. So, for example, just by going to corporate bonds, there's all different grades of corporate bonds, you can get more interest, right? So just like we have a FICO score as individuals, and when we go to a bank to get a loan, the interest rate that we'd have to pay on the loan depends upon our FICO score, our overall credit score. The higher it is, the lower interest. The lower it is, the more interest, right? So by gauging that properly, you can still get into things that are fairly secure, but pay a lot more than 4%. What you can also do is get into other what I call bond-like instruments. So, for example, you can get into preferreds, right? Now, preferreds are technically a class of stock, but frankly, they're more bond-like in many ways. When they declare a dividend, that dividend is fixed, right? Essentially, if they don't pay the dividend, it's considered, for most, like a default, right? Like a bond. So, and preferreds will pay a little bit more than equivalent or similar bonds. So that's good. Then there's other bond-like instruments. There's the ability to get into things like business development companies, which essentially make loans to medium-sized companies, right? All a bond is a loan, and that makes loans to medium-sized companies, right? And then you get different stocks that can pay a higher dividend, a higher I component or income component. So when you put all those together in a healthy, diversified mix, yes, Donovan, you can get 7% before fees and 6% after fees, which, like I said, if you take 4%, that means you've got automatic built-in 2% reinvestment inflation hedge.
Donovan, thank you so much for calling in and giving us your Ask Dave question and for listening to the show. Now, if you have a question, if you would love to get your question answered on a future Ask Dave segment, you can always give us a call. Our phone number is 833-RIS-RADIO. That's 833-747-7234. All right, Dave, let's get into it. We have our question here from Kelly in Avon. She says, dividend stocks tend to do well in a lower interest rate environment. Dave, you mentioned this. I just don't know, how can I choose the right dividend stocks?
All right, Kelly. Well, it sounds like you're a do-it-yourselfer. You love to manage your own money, and that's great. Except my answer would be you may not be able to when it comes to dividend stocks. Dividend stocks are one of the most difficult things to do in the investment world. Choosing bonds and bond-like instruments is a challenge, but it's basically doing credit analysis with a company. So a lot of people are good with numbers, or if you ever worked at a bank approving loans, well, this fits right in, right? Now, the problem with bonds and bond-like instruments is how do you buy them and get a fair price because they're negotiated, right? So you may need a professional to help you negotiate the right yield, just like, when you buy a piece of real estate, you have to negotiate it. It's not like a stock where you push the button, you know what price you're going to get. But the research is easier. Growth stocks, same thing, Kelly, is easy because growth stocks, capital appreciation stocks have momentum. They're going up. Tech stocks are hot. So you buy tech stocks, you ride them up. As soon as the trend reverses itself, you sell. Maybe you put a stop loss in so it sells automatically. Dividend stocks are the hardest, and here's why. Anything that's growth-oriented isn't going to pay a high dividend because they feel like they can reinvest the profits in the company to grow the company internally. And that's more important than paying a dividend to shareholders. So by definition, when you're paying a dividend to shareholders, you're investing in a company that is in the mature part of the life cycle, the corporate life cycle. Well, there's different parts to the mature portion, right? There's the beginning, the middle, and there's the end. And if you get to the end part of the mature, well, then guess what happens after that? Well, the decline, right? Think of all the great companies that have been great and then declined or disappeared. In fact, the 30 biggest companies in the Dow Jones Industrial Average just 100 years ago, none of them exist today. They all went bankrupt or got taken over. So you have to ride that knife's edge between those that are mature but still have some growth potential versus those that are mature and might go into decline. As an analyst, we call it value versus value trap, right? In life, there's certain things you can, I've got a buddy that likes to buy things cheap, and sometimes he confuses value for value trap, right? He buys something because the price is cheap, and then he's got to put more money into it to support it, and it becomes a losing venture. Versus buying something that's a little more expensive but a good value, where over the life of holding that particular asset, it costs you less. This is, buying boats, right? You can buy a boat. Airplanes, same thing. You could buy an airplane at auction. It's really cheap, and you have to put a lot of money in to keep it up to speed. Same with stocks. So you can get something that's a value or something that's a value trap, which means it's probably going to have declining profits, which means they're going to have to cut the dividend eventually. When they cut the dividend eventually, the price goes down, and it becomes the corporate death spiral. So that's the tough part. In order to differentiate that, Kelly, you can't just look at the financials of a company. You have to look subjectively about the direction in which that company's heading, where they are in terms of market share in their industry, look at the industry as a whole. And the only way to do that is by talking to lots of people, analysts who know what they're doing, talking to shareholder services at the company, knowing what questions to ask. So again, hate to say it, I know you love to do it yourself. It sounds like, Kelly, but this may be something that you may not want to try alone at home.
Absolutely. Well, Kelly, thank you so much for calling us in. Again, that phone number is 833-RIS Radio, 833-747-7234. We would love to hear from you. And the thing is, too, Dave, is, what got you up to this point, if you've been really successful with DIY, or even if you've worked with an advisor that's focused on capital appreciation, it's not going to be the same strategies, the same things that you need to do once you get into retirement. You have to change that strategy a little bit to be able to keep up and to really generate the income that you need. And
arguably, even if it weren't as difficult as dividend stocks to determine a value versus value trap, these are great questions. I love the questions that came in today. These are awesome. But even if it weren't that difficult or easier, you still have to ask yourself, okay, if this isn't something I've ever done, I could go get a lot of good textbook knowledge, and I'm smart enough to do it myself, but without real-world experience, is it really worth my life savings?
Yep.
Yeah.
And the other alternative is you can work with the income specialists here at Retirement Income Source. We have income advisors all over the country who would be happy to explain the strategies that they can use to generate income to you. So if you're looking for more information, please reach out to us. You can reach out to us on our website, incomeradio.com.
And most important, we hope that you're here with us also next week. Same time, same station. I'm David Scranton here with Sarah Samuels, and you've been listening to the Retirement Income Source, where it's all about your income.